Here's the basic fact pattern, and we're going to diagnose this as a group. Okay? You have S and P. S is an engineer who has a really great idea. P says that's a really great idea. They form X. X gets a loan for $1 million. P guarantees the money. He's the guarantee guy. They go for a period of 5 years, losing systematically $200,000 a year. Morning, Distel. Or Disler. Really? How you doing this morning? Oh my God, you and him, but you showing up late, you two were the deep ones, I hear. Okay, so they lose systematically $200,000 a year for 5 years. In year 6, they file 2553. Brand new client. They came from Lane and Associates.
I feel bad for them.
Do what?
I feel bad.
No. You've reformed.
Oh, 754 was good.
Yes, that was. However, you prepared the past 5 years, and this is the only activity for P and S. 5 years returns, and she did it absolutely right. I'll give you that data point. Okay. So, do what?
It would be hard to account for if you were like, oh, and also she messed up all the returns.
Correct. Because you have to know how they were messed up. So the question is, how were the first 5 years of returns prepared by Lane and Associates? And then what happens in year 6 when you do the 2553? And the first question has to do with the first round. Anybody?
Wait, the first round of what?
You weren't here. So
Okay.
you're exempt.
Okay, thanks.
What's the first question?
I don't know what the first question is.
What? Can you repeat the first question?
How were the first 5 years prepared? What, if you looked at the return, what would you expect the return to look like?
Like what form is it on?
No.
A loss of $200,000.
A loss of $200,000. How does everybody feel about TransAnswer of a loss of $200,000? You feel good about that?
I think so.
Yeah.
I think I just got an F for first round. Everybody feels good about a $200,000 loss being taken on those returns.
On the business return?
No, on P's return. Sorry, you're right. I was not exact in my question. On P's return or S's return?
Oh, on P's return,
Yeah.
he couldn't have taken any of those losses because it's passive.
He's got a carryover.
Okay. So do you want to tell everybody what that means, Kaylee?
Well, P
Hold on, start at the beginning. What concept are we playing with?
passive activity loss.
Loss hurdles. Okay. Tatum, how do you feel about loss hurdles?
Terrible.
Terrible? Why?
It was just the worst subject of Let's Learn Some Tax 1.
It was? Well, we
I
have to
so
use it all the
worst.
time. Emma, how do you feel about it?
To be honest, I don't remember a lot of it.
You don't? Well, this is kind of important. Okay, Kaylee, what do we have? What's our first hurdle?
This is what I pull the manual out for, Pete. Is it passive or active?
Yeah.
No, that's hurdle 3.
Oh.
Accepting the loss.
Accepting the loss. This is not therapy.
First, it's just denial.
Basis. With your chest. No.
Would it be basis?
Oh, a chamber. I said it.
Well, have some confidence, man.
That's what I said. Say it with your chest, and he's like, no.
Is that what just happened?
Yeah, he said basis. Yeah.
Then what's after that, Jack?
Outside base.
Outside basis.
Outside basis? How about at-risk basis?
That's what I meant. Yeah.
Okay. There's a difference.
And then it's passive active.
Then it's passive versus active.
Yeah.
And then what? Excess business loss. Right? So now you have diagnosed that on P's return, there's how much of a carryover due to passive activity? $1 million. Okay? So now we're into the more recent material. What happens when they file a 2553 and the balance sheet of the entity, which is inferred on some level, is liability, 1 million, equity, P, negative 1 million, equity, S, 0. What happens? What happens when we file that 2553? Jameson?
The NOL is no longer applicable.
The NOL is no longer applicable. What does that mean? Morning, Eli.
Wait, am I thinking of the wrong? Oh, what is this?
It's a partnership. Oh, triangles are always partnerships.
Oh,
When we file a 2553.
oh, then never mind.
What is it, Lane?
S corp election.
S corp election. And what Red Proc are we under?
351.
That's the code section. 84,
11.
Oh.
84-111. And what option under 84-111 do we have? Situation 1. What's situation 1 say, Emma?
Partnership transfers their assets to,
Say it. Sorry, I legitimately didn't hear you.
partnership transfers their assets to the SK,
Yep.
and then purchase stock, and then they give stock to individuals.
Yep. Okay. So, if that's the case, why don't you guys work on what the answer is? I gotta log in. This will give you a chance to write something down. We ready? Okay, what's the answer? Walk me through it. Who wants to walk through it? Jack, fire away, man.
Oh shoot, why did I do that? Okay, start with 351.
Yep.
So, oh shoot, now I'm overthinking it.
Don't do that, Jack.
Taxable or tax deferred?
It's tax deferred because I'm forgetting the first part of that.
Say it in the mic. No, you forgot.
You're transferring assets, but are they?
That's actually a really good question.
That's where I just started
100%, that's a great question. Clearly, we're transferring something which is a going concern. It just happens to be upside down.
Okay.
I mean, we have a business operation that we're running. It's just upside down.
Okay, and you're getting shares for it, and the transferring group is over 80%.
Who's the transferring group in this case?
It'd be the partnership.
X. Yep.
So then you go to 357C
Yep.
to
And why do we start there?
see if there's any gain.
Okay. And why do we want to know if there's gain?
Because it affects 358 and 362.
Perfect.
So that in excess of basis is $1 million. So that's your gain.
Yep.
So then you go to 358, basis in shares, which is 0 because you had a gain. You got a 357C gain.
Basis in the asset transferred was 0.
Yeah,
Gain recognized was
$1 million.
$1 million. Boot transferred, which is debt. How much?
Oh, $1 million.
So $1 million gain recognized, boot transferred of $1 million. You come down to 0.
Yeah.
0 basis shares. Perfect.
Yep. And then 362 is the corporation's basis in the
Correct.
assets.
Yep.
I'm struggling through this. So the original basis would it be 0 or
0.
Okay. And then the gain recognized is $1 million.
Yep.
So now they have $1 million new asset. So
Yep.
in the holding period there's nothing, you're not transferring any actual asset over, so there's no like tacking, right?
Correct. There's no 168 I-7 that we have to deal with.
Yeah, so I feel like you kind of skip through 1223.1.
You don't skip through it. It just doesn't apply. You still have to apply it.
Okay. But you have a new asset
Yep.
that's the $1 million gain.
Yep.
And what would you depreciate? How would you depreciate that since you have no like asset?
That's a great question. We're just going to say it's going to be intangible properties because that's basically what we're working on 15 years.
Okay. That's a very good question. Which is 168 I-7.
Okay. And then what happens? You aren't done, Jack. And if you don't know, call in somebody.
8411, I don't know.
No, you're on it.
I might need to call on someone.
Who would you like to call in?
Emma.
Emma, what's 84111 say at this point? Well, let me ask this question. Have you tracked with Jack to this point? You know where Jack is in the process. Okay? So do you know what happens next?
Not necessarily.
Not necessarily. Who would you like to call in?
Lane.
She didn't look all that disappointed. Lane, what happens next?
Well, you have to do something like, I created a balance sheet first.
Fine. What's that balance sheet?
Asset, million, liability, million, equity, zero.
Correct. And then what happens next?
I don't know.
Okay.
Something with the K1. We talked about that yesterday.
We did. How much gain? That's good. How much? That's something. Let's go down that $1 million. And who's that allocated to based on?
P.
Yep, Pete, because he's the one who has the debt fund losses. Fine. Okay. Then what happens?
That would,
Who has the stock when the dust settles, and how did it get there?
and the new corp.
Well, the new corp issued the stock. Who has the new corp stock? Who's the owner of the new corp?
Pete.
And
S. Whoever that is.
Steve.
Steve.
Yeah. Okay. So how did it get there?
It was transferred.
The partnership liquidated under 84111. So what was the partnership liquidation rule that we had yesterday that everybody should remember?
Don't remember.
Anybody? What is it?
You gotta deplete the basis or
For what?
cash.
And then
Assets are C.
Everything else.
then assets are going to inherit the remaining basis. So Pete's beginning basis was what? Thomas?
Zero.
Negative million. How much did the K1 go to Pete?
Half.
No, million.
Oh, million.
So his went from a negative million to $1 million, right?
Mm-hmm.
So now using your partnership liquidation rule, cash depletes basis first. Was there cash?
Mm-hmm.
There was not.
No.
So now we distribute the property, which is the new corp stock. And now the basis remaining and Pete's interest and Steve's interest tack onto the distributed shares, which is what's Pete's basis? What's Steve's basis?
Zero.
Now, how do you guys think you did versus what you learned yesterday?
Pretty good, honestly.
Wow, Lane's coming right out of the chute. You think you did pretty good, Lane?
Yeah.
I think you did pretty good too. But stupid question, and this is for Jack, because Jack took the bullet right out of the chute. The stupid question. How much income did Pete have? How much?
Million?
$1 million. How much is Pete going to pay tax on?
0.
Why?
Depleted his basis went to 0 from it. You had a loss.
I have $1 million, right? But you still have a loss carrying over, correct?
Mm-hmm.
Can I use that loss? You say yes. I'm going to say yes, but for hopefully a fully funded Scooters gift card, why do I get to use the loss?
Because
Go ahead. He raised his hand, but you started speaking.
you generated income.
Yes, that's correct.
You can get it. You can only take a loss if you have income. You can't take losses.
But you still have to run the loss through the loss hurdles?
Yes.
Yes. Did you do that?
No.
No. What do you got?
Well, during the last year in business, aren't you able to take the passive losses? Or is it not technically the last year in business since it changed to an S corp?
How do you feel about that, Campy?
I don't think it's the last year in business.
Well, I think what Trent's saying, in a year of disposition, you can release the passive loss.
I would say we did not dispose of the activity.
Okay? I honestly don't know the answer to that. Because I could be convinced either way, that you're right, and I could be convinced that you're right. I honestly don't know the answer. However, What I would say is that I had the disposition or a gain associated with the transfer of a passive activity, and the gain associated with the transfer of a passive activity is passive income.
Therefore,
Isn't that what Lane was saying? We had.
Yeah,
no, she said I had income.
well, you generate the income is from.
You did not.
the
You did not classify it as passive.
All
Are
right,
you gonna be? Are you gonna be honest about that?
Right. I like Lane's answer.
Do you think she narrowed it to passive or not?
Well, okay, well,
Lane, or did you narrow it to passive or not? And you're going to rob him of a gift card if you say yes.
you can have it.
Yes or no?
You can have it.
No, yes or no?
I knew it was passive.
You promise?
I promise.
Okay, then Campy's right, I'm wrong. And Lane,
But Trent can still have the gift card.
I don't want it.
you don't want it?
Nope.
It's
Oh.
probably 0 anyways.
That
cracks me up.
Wait, you got 0?
I kind of bad about it, but not enough bad to give you another card.
I don't know.
I believe her. I believe her.
Have any of the gift cards been confirmed to be
Yeah.
accurate?
Yeah, well, you said the other one loaded.
Oh, not $10.
And if they're not, that'd be a great gag to play. And it would be Haley McGargle that did it.
Ain't nobody to answer your questions next go round.
It would still be funny.
For a year.
For a year, it would be. Okay, so yesterday we covered 351, 84,111, 1001. Why did we cover 1001? Did we cover 1001 because when property is distributed out of the corporation has to go through the sale and exchange process. You have to determine the fair value of the property, compare it to the basis, and calculate a gain or loss. And that was under 311. Well, no, we used 311 with distribution. Sorry, 1000. We used 1001 in conjunction with 311. So the next piece that we're going to talk about today is corporate liquidation. Let's see. Lucas, what's corporate liquidation say?
What is a corporate liquidation? There are two transactions that occur in liquidation. The first transaction is the corporation distributes or transfers all of the corporate assets to the shareholders. The second transaction is that the shareholders surrender their stock in the corporation in exchange for the corporate assets.
Okay, so starting point, A owns 100 shares, land's in Exco, they liquidate, the land's transferred to A surrenders its shares, A owns the land and Exco no longer exists. That's a corporate liquidation. Okay? So, with that said, Lucas, what's number 2 say?
If the liquidating corporation is owned by another corporation or an individual or a partnership, do different rules apply to the liquidating corporation? Yes, there are two possible results.
There are two possible results. And those two possible results is either a taxable liquidation, where 1001 is applied, or it's a tax-deferred liquidation, where 1001 is turned off. So on this page, which I don't know if this is going to be helpful or not, I don't know whether it's post-it worthy or not, but there's 2 categories. Lucas, who would you like to call in?
Isler.
How you doing, JD?
I'm okay.
All right. Do you need coffee? We want to get you off to a good start. What's taxable liquidation? What's that column say?
Taxable liquidation. 1, individual owns the corp. 2, partnership owns the corp. 3, a corporation owns less than 80% of the stock of the liquidating corp. 4, the liquidating corporation is insolvent.
Okay, so we're going to put a pin in insolvent versus solvent for a second. Okay, so what's tax deferred say?
A corporation owns 80% or more of the liquidating corporation, and the liquidating corporation is solvent.
Okay, so if we were going to put that into a picture, it would be X is owned by an individual or a partnership, or less than 80%, or insolvent. That would be taxable. The other would be X is owned at least 80% by another corp, and X is solvent. Okay, so solvency is pretty important in the middle of this rule. And we're going to deal with the tax deferred liquidation when we talk about sub sandwiches, Jimmy?
Q subs.
Q subs. Q subs, not sub sandwiches. Correct. You can make that joke later. Okay, so there's taxable and there's tax deferred. Under taxable, you have to apply the concepts under 1001 to say the corporation's selling the assets at fair value and the shareholders are selling their stock at fair value, and we're going to cover that. Tax deferred is, we're going to go through that says here's a corporate consequence, here's a shareholder consequence, and here's the basis in the assets. Oh, solvency. Okay. This actually is worth noting and highlighting because this is not the only time this is ever going to come up. This definition is applied in more than one spot in terms of the concepts we have to apply as professionals, so this, again, is a rule that's worth knowing. Solvency of a corporation is measured by comparing the fair market value of the corporate assets to the corporation's debt. So, stupid question. This balance sheet, for this, we're going to pretend this X is a corporation, not a partnership, just for a second. There's $1 million liability, $1 million of equity, or negative equity. Jameson, are we solvent or are we insolvent?
I don't know the fair market value.
You don't know the fair market value. That's exactly right. The fact that that balance sheet is upside down, you're missing a data point in determining and being able to measure solvency for that particular entity. So, fair market value is $2 million, Jameson, then I'm solvent. If it's $500,000, I'm insolvent. So the definition is applied in tax-deferred corporate liquidation, and it's also applied in your bankruptcy or your cancellation of debt rules under Section 108. So, with that said, if we have a corporate liquidation, we're going to talk about both of them. Who was the last person? JD, who you want to call on?
TK.
Okay, what's this say?
What tax rules apply to a taxable corporate liquidation? Since there are two transactions, there are two rules. One rule addresses the tax consequence of the corporation distributing assets. The second rule addresses the tax consequences of the shareholder surrendering their shares in exchange for the corporate assets received in liquidation.
Okay, we're going to stop you right there for just 1 second. Okay? So we have X, which is owned by A, and you have land. Okay? What that's saying is there's a corporate consequence, or there's a consequence, excuse me, there's a consequence to the corporation of transferring that land. That's consequence number 1. And we'll read this, but that's section 336. There's a second transaction that's occurring, and that is A is surrendering X stock back, and that's consequence number 2. And that is 331. Okay, so Thomas, what's that say in terms of 336?
The rule states that the corporation is deemed to sell the distributed assets at fair market value. Let's assume X Co's land had a fair market value of 1,000 and a basis of 100. What do you think 336 tells you as the prepared to do?
What do you think?
They'd have a gain of 900.
Okay, because under taxable liquidation, 1001 is in play.
Mm-hmm.
You have to take the fair market value of the asset, which was how much, TK?
1,000.
1,000 versus what's my basis?
100.
100. So 1001 in a taxable liquidation tells you that you have how much of a gain? 900. So that's consequence number 1 that we have where the land is moving from the corporation out to the shareholder. That's consequence number one, and that's what 336 is telling you to do. You have to measure the gain associated with the assets that are being transferred from the corporation out to the shareholders. Okay? TK, what's number 2 say?
The rule states that the shareholder is treated as selling their stock in the corporation in exchange for the corporate assets received in liquidation. If we assume A's basis and XCO shown is $100, what are the consequences under 331? Assuming XCO is a C Corp, XCO is an S Corp, what is the character of the gain and what is the basis in the assets received?
Okay, so let's talk about that. There's a lot of things that are occurring in that paragraph. So consequence number 2 is A is surrendered their shares back to the corporation and they receive something. Sam, what's my favorite definition of proceeds? What are the 3 things? If you don't know, call on somebody.
Cash,
Cash,
debt relief,
debt relief,
and property.
property received. Okay, so now we're going to focus in on A, because on the corporate side, to me this is a little bit more narrow, because it's saying what exactly is the fair value of the asset that's being distributed. You're under 1001, compare it to basis. In this case, you can get multiple assets, you get cash, you get property, you get all sorts of stuff. So in this case, 331 says quantify your proceeds. Cash, property, debt relief, which there's never going to be that. Well, there might be, but I doubt it. Cash was 0. Property, what is the fair value of the property coming out, Sam?
Did we know?
Yep. How much, TK?
1,000.
1,000. Because what the calculation under 336, we said it was 1,000. We compared it to the 100 of had $900 gain. So your key indicator of how to populate the proceeds for the shareholder is what was the fair value at the entity level? And the fair value at the entity level was, Sam?
1,000.
Okay. So my total proceeds for 331 / stock sale is how much, Sam?
1,000.
1,000. Okay, so now we're going to focus in on, we've quantified the proceeds side of this, but we have 1, 2, 3, and 4. Okay? So what if XCO, Sam, is a C Corp?
Well, then we would go to your tree
What tree? I can't
that
wait.
you just looked at, right?
I have no idea what you're talking about, but I'm excited to hear where you're
The
going.
2 possible results. Do we look at that?
No. You're talking about taxable or tax deferred?
Yeah.
Nope.
Do we look at that at all?
Nope.
No.
This is driving at, and the point I'm trying to make is, do you adjust the basis of the stock for the transaction that occurred when the corporation liquidates? That's the point that this is trying to make.
And the tree, I think, has to do with who the owner is, not who the liquidating entity is.
Gotcha.
Correct.
Okay. Okay.
So if it's a C Corp and there's C Corp income, do you adjust the basis of the C Corp shares?
No.
No. So the basis in my fact pattern was how much? I think it was 100
Right. Bases.
in the shares.
Yeah. 100.
Was 100. Okay, so now I know that my basis is $100 under a C Corp. So my gain is 900. If it's an S Corp, do we adjust basis?
Yeah.
We do. So the gain from transaction 1 was $900. My beginning basis was 100. My K1 was 900. My ending basis was 1,000. And now, oops, I have no gain or loss, because I get to adjust my basis up or down for that transaction that occurred under 336 or transaction 1 or corporate level transaction. So what's character of the gain? Who knows? You're gonna have to make a, what do we do, Trent?
Diagnose.
You have to diagnose what is the asset that's being distributed from the corporation and what character is it? If it's cash basis AR, Trent, what's the character of the gain?
Ordinary.
Ordinary. What if it's a stock held in Apple that we just have?
Capital.
Capital. What if it's a building that has depreciation of original cost of 1,000 and depreciation of 500?
It depends.
It depends on what. I love the depends because that could be right. I wasn't expecting depends, but
If we accelerated any of the depreciation,
if we accelerated any depreciation, let's presume that we have not, because that was another subset of diagnosing how to get the character, right? We didn't take any accelerated. It was all straight line.
1250 under captured.
1250 under captured at what tax rate?
25%.
25%. So you have to diagnose what the character is based on the asset that's being distributed out of the corporation. What is the basis in the asset received? Trent, who you want to call on?
Lucas.
Lucas, what's the basis? Which the land is what was being distributed. So I'm referring to the land. What's the basis of the land in A's hands after we go through the corporate liquidation?
Be 1,000, right?
It'd be 1,000, because the corporation paid 1,000, had 1,000, but I surrendered my shares. More importantly, it was valued at 1,000 when I got it. So whatever my proceeds are, for transaction number 2 or 331 or the surrender of shares, that's going to be the basis in the property that I've received.
Pete, how would that change if we had depreciable property in there? Would it?
Oh, he wants to talk about the Snyder rule. You want to talk about the Snyder rule?
I honestly don't know, but I'm aware Snyder maybe says ignore it.
Okay. Which I hate this rule. Okay, this is not my favorite rule, and I'm not going to say anything to the effect of the level to which this may or may not be ignored, because I don't know if my sister will actually edit this out. So we never ignore this rule. Okay, so what John Canfey is talking about is Code Section 1239. And we're going to change land to, I'm going to say a house. Okay, and I'm going to say that house, to be very clear, was personal in nature at the corporate level. We just use it, and people take it into W-2 because it's a perk. Never depreciated. That's house. And A, being the sole shareholder, says, well, no, A's dad. Okay? A equals dad in this scenario. And son says, you know what? That's a waste that is in that corporation. I'm going to buy that house for $1 million. I'm going to get the house. And my opportunity is $300,000 a year in rent. But at $1 million a year, that's going to generate, we're going to say $100,000 depreciation. So I'm going to get taxed on $200,000. And when it's sold, just so you know, the house was originally bought for $100,000 in 1972 in California. So what John's saying, and this applies in liquidation as well, but we're going to broaden the rule because this same thing applies in liquidation. If the house or the asset is sold to a related party. Is son related to dad? For purposes, yes, that's going to be a given. If an entity sells an asset to A in liquidation, who's related to the corporation, or to son, who's related to dad, who owns the corporation, any transaction where a corporation or an entity is selling a depreciable asset to a related party. So this is the hard part of this rule because it almost feels inverted. Did the corporation depreciate the property in my fact pattern? They did not. So the measurement of depreciable property is not with respect to the seller. The measurement for depreciable property is with buyer. So if buyer buys the house with the intent to depreciate it, now 1239 is in play if they're related. And what 1239 says, and I think this is catastrophically stupid, this is a bad rule. It says that, Nicola, what's my gain on the house? I got $100,000 a basis and $1 million sales price.
900.
900,000. It was never depreciated. I have $900,000 of appreciation. And corporation just bought it as an investment, held it, and just dinked around with it. So if you sold that house, you would expect whatever gain to be associated with that house to be capital in nature. 1239, or this related party rule, says if a related party, X, and it's related to S by virtue of it being owned by dad, A, if you sell that to a related party, son, the 100% of the gain is ordinary. Likewise, if that house is sitting in there, and now I'm going to change the rules, or change the fact pattern, we liquidate the company, and it comes out under 336, and A, dad has the intention to depreciate that property, it comes out as ordinary income. And we do, in fact, confront that. There's lots of entities we wanted to kill over the years, and one of the things that stopped us from killing it was a car dealership had a property from 1972 with $100,000 of basis in it, with lots of appreciation, and if we liquidate the company because it was favorable to do so under tax rates, well, it wasn't, because everything was going to come out as ordinary. 1239 is a bad rule. But so, I'm not going to go down that path, never mind.
Why is it in place?
I don't know. Well, here's my theory, honestly, is if this was not a house, but it was a widget machine, and that widget machine could be written off right now with bonus depreciation, and I'm able to harvest a good tax rate on the liquidation or sale of it, and then whoever gets an automatic bonus depreciation write-off, because we can do it now, that rule makes absolute sense to me, because the IRS is in parity with the income event and the deduction event. But when it comes to a house is depreciated over, a rental house is depreciated over how many years? You don't know?
I don't know off the top of my head. 27 or not.
27 and a half.
I was just not confident in my answer.
Yeah, Pete, I would say if this rule doesn't exist, this would be a strategy that everybody would do is they'd have it in the corp, you'd liquidate your corp, trigger capital gain, and then just.
Yeah, but over 27 and a half years, it just equalizes.
Well,
And that's the thing
but
with
if you had,
everything else.
I guess you'd need appreciated personal property, which doesn't happen often.
Correct.
I mean, I can completely see it on a short-lived, quick write-off asset. The parity makes absolute sense to me there. But when it's a 27.5-year or a 39-year property, it makes no sense to me at all. But we follow the rule.
So the punchline is if you have depreciable property in your corp and you want to liquidate the corp, that might feel like it would be capital gain, but some people would tell you it is not.
Let's see. Why am I not? Oh, damn it. I didn't print it. Whatever. Okay, so I didn't say this, but 334 says if a property is received in distribution in complete liquidation, and if gain or loss is recognized, receipt of such property is the basis equal to fair market value. And that's what we did. Okay? So I didn't say 334 because in my mind, 334 is more important for, or I key in more on 334 with tax deferred transactions. Because in my mind, taxable transactions, mentally it's so clear to me the basis equals the fair value of what I had to report gain on. That's just intuitive to me. Let's see. Oh. I have an example. Trent, who you want to call in?
Jameson.
Jameson? What's this say?
A stock basis is 1,000. B stock basis is 10,000. Esco is an S corp. Exco's balance sheet is as follows.
Okay.
Do you want me to read the balance sheet?
Everybody can read the balance sheet. But the other thing that I did not put up there is A and B is inferred or 50-50. I didn't say that. I should have said that. Because that's important to how you're going to calculate this out.
You said they're 50-50?
Yes. So what are the consequences to Exco? What are the consequences to A and B upon liquidation of X? Do you think, based on the brief thing that we did, you have the tools to do the calc? We have transaction 1, corporate. That's where you start. There might be a K1. There's transaction number 2, where the person, after you adjust the basis, surrenders their stock, and you have to do a gain-loss calc. Do you need more than that? Can you do the calc? Do we do it together? I've never seen a more disinterested look of a population in my life.
We'll do it together.
We'll do it together. Fine. Then, Jameson?
Oh, no.
No, we're going to do this together.
Yeah.
You, for each piece, are going to tell me the step, but you get to call in the person who has to tell me how the step unfolds.
Okay.
Okay? What's step 1?
Step number 1 has to do with 336.
Which is what?
The corp.
The corporate consequence. What's the corporate consequence? Now I'm asking you. Who are you going to call on? I'm violating my own rule.
TK.
TK, how would you describe what the corporate consequence should be?
We pick if it gained.
Sorry?
Just that we have it gained.
Okay. And what's the process of determining that gain? What do you compare? What's your starting point of the analysis, and what do you compare that starting point of the analysis to?
Just a fair market value.
Fair market value. What's the fair market value?
30,000.
30,000. Okay.
And our basis is 11,000.
Your base is 11,000.
Mm-hmm. So then gain is 19.
Your gain is 19. I should have made that 20 for ease of math. I should have. But 19,000 divided by 2 is what, Nicola?
9.5.
Huh?
9.5.
9.5. Okay. So now we know the population gain. We know it's 9.5. And I didn't intend to ask this when I did this, but what's the character of the gain?
Ordinary.
Ordinary? What's ordinary?
It depends.
Well, so you have to do what, Trent?
Diagnose.
Diagnose. And in this case, how many assets do we have?
3.
3. So how many diagnoses do we have?
3.
One capital, 2 ordinary.
Well,
depending on how long.
the cash is always going to be cash. You're never going to have a gain or loss on cash,
Yeah.
right?
Yeah.
So AR is always going to be ordinary. Land is going to require what, Trent?
Looking back to see if we've taken 1231 losses.
Diagnosis. Diagnosis. There's lots of questions you have to ask. Is it a 1231 asset? Is it a capital asset? Is it an inventory? What is that? So you'd have additional questions to what, Trent? Diagnose the character of that gain. So we're going to call it 1231 and call it, or we're going to call it capital, because I don't want to get into 1231 unrecaptured losses or go down that rabbit hole. So we have capital gain of 9, ordinary of 10. And that's just, you know, we're not going to go down that rabbit hole. We're not going to do tax rates, but that's worth highlighting that we have to diagnose each asset and what character is going to be inflicted on that each asset when it's being distributed out of the corporation in complete liquidation under 336, because the starting point is the corporation is distributing its assets. It's coming out at fair value. You have to compare that fair value to basis. When you compare that fair value to basis, you're going to get a gain, and then you have to make a determination of that gain's character in liquidation. Does all that make sense? So this is a stupid question. I love my stupid questions. How much debt's on the balance sheet? Kaylee?
10,000.
10,000. Well, that's coming out too. What is that?
It's part of the proceeds. It's debt relief to the court.
It can be. Okay, we're not, if debt is in excess of the fair value of the assets of the corporation, then it's proceeds. But we're not going to, hold on, TK, are we here to learn or are we here to be experts? We're here to learn. The debt in excess of basis of the assets of the corporation, that's more expert. So I'm going to push that one aside and turn off that rule for purposes of our discussion. Okay? But there's debt on the balance sheet, and it's coming out of the corporation. What is that? How do we interact with that? And I'm not expecting you to know, because at the end of the day, when I go back to, you went to my automatic, what's my definition of proceeds, right? Of cash, debt relief, and that sure looks like the corporation has debt relief. That is not the lens that we look through, but the lens that I'm going to say that we look through is wildly important and does come up, because the debt in excess of fair value, that's a pretty limited fact pattern. That doesn't occur all the time. But liquidation of a corporation where somebody is assuming the debt, that comes up all the time. And that comes up all the time from the standpoint of if there's a company that's selling and there's debt that's left behind, the sellers might have to assume that debt. Buyers may not take that debt. So the corporation liquidates out that debt and puts it into the shareholder hands. So let's talk about funding of a corporation. So if, in example 1, if we fund a corporation and we fund the corporation with $10,000 of cash, and we're going to put it in the context of a single shareholder. If an individual puts $10,000 into a corporation just to fund it, does basis go up or down with respect to the cash going into the corporation? Emma? Up. Right. So my basis, I'm going to start at 0. I start a corporation, I put in $10,000. My beginning basis under that scenario is how much, Emma?
10,000.
Okay. If I have a corporation that has $10,000 of debt, and I'm required to pay that debt, and I contribute $10,000 to the corporation, and the corporation pays off that debt, did my basis go up by virtue of me contributing $10,000, Emma? It did. So $10,000 goes into the corporate bank account. $10,000 then goes to pay John Canfy's Let's invoice, and all's good. In that case, it's very clear that basis is going to rise by virtue of that cash contribution to the company. However, when you liquidate the company and you take the debt out, how's that different than you putting money in to pay off the debt? It's not. I took on a corporate liability. Since I took on that corporate liability, my basis is going to go up to the extent I assume that corporate liability. Because my option could be, I could literally put the cash in the company. And it's very clear to everybody in the room, at least on some level, that the contribution of the cash to the corporation is an increase of the basis to the stock of the corporation. It is not intuitive, and it is not clear that if you take a debt out of the company and take on that responsibility, that that's a basis increase. So if that debt comes out, Emma, from the corporation on a 50-50 basis, how much does Pete's basis go up and how much does, or whoever, I don't even remember who my,
5.
5. A and B. So if you were creating a basis schedule, what's my beginning basis number, Emma? For A and B. What's A's beginning basis before we do anything? What's A say?
Oh, 1,000.
1,000. What's B's basis?
10.
10. So if we now, A and B agree that they're taking on that liability, what's B's basis adjust to and what's A's basis adjust to?
6 and 5.
6 and 15. 6 and 15. Okay? So, was it you that did the gain loss calc, TK? How much was the gain on liquidation?
19.
19. And Nicola, how much K1 income is coming out per person?
9.5.
9.5. So, Emma, beginning basis was 1,000 for A. Beginning basis for B was 10,000. We increased it for what?
The debt.
The debt, which was how much?
5,000.
5 each. So my basis went from 1,000 for A to 6. The debt, the basis for B went from 10 to 15. So now, Nicola produces a K1 under the supervision of Lane Enterprises of 9.5. What's that do to the basis for A and B?
Increases them each by 9.5.
By 9.5. So 6 plus 9.5 is?
15.5.
15.5. 15 plus 9.5 is?
24.5.
24.5. Okay? So now we've confronted the transaction where we're liquidating the corporation, which produced a gain of 19, which produced K1s of 9.5. We took out debt from the corporation, 5,000 each, which has revised our basis from 1,000 for A to 9. What was my number for
15.5.
A? 15.5 and 24.5. Okay, so we're now through the 336 transaction number 1 for the liquidation of the corporation. So now, transaction number 2, Emma, who do you want to call on?
Tatum.
Tatum, what's transaction number 2?
Hold on.
Take your time, kid.
The 331?
The 331. What's 331 say?
Shareholder selling the stock in the corp in exchange for the assets.
Okay, so when we're selling our stock in the corporation, our beginning starting point when we went back to proceeds over here was tied to the fair value of the company's assets, correct? Was that correct or no?
Yep.
I still can't hear you.
Yep.
Yep. Yep, it is. Okay, so how much was fair value? How much is fair value of the assets?
30,000.
30,000. So A's proceeds are going to be A is 50%.
Oh, 15.
15, and B is 15. So now I know the proceeds associated with those. Now, your good friend Emma has been working diligently in preparing the basis schedule for A and B. Do you remember the basis schedule that was prepared by Emma?
Yep.
And how much basis did they have?
15.5 and 24.5.
Okay, so I have 15 of proceeds and 15.5 of basis. Do I have a gain or loss in liquidation on the stock?
Loss.
Of how much?
500.
500. And B has
24.5 and 15.
how much loss?
Whatever that is.
9.5. Okay? So, taxable. How often do I use these rules, John?
Often.
Often. I use these rules all the time. Okay? Now, are we here to be experts? We're not. But having the awareness that the liquidation of a corporation by an individual, a partnership, a corporation with less than 80%, a corporation that's being dissolved that's insolvent is a taxable liquidation should prompt you to go, I need to go back and figure out what this really means. But the one we're really going to hammer on today is tax deferred.
As a reasonableness check, I think this is true. If I was running the math on liquidating an S corp, if I had owned those shares from inception, I would not anticipate a gain or loss on ultimately the redemption when the shareholder receives property in exchange for the stock. That would not be the case if I bought the shares from Pete. So I mean, you need to run through the math, but I think conceptually that's usually how it works out. Do you agree with that?
100%. So actually that's a great point, and actually that will potentially help drive that home, because that's an exercise that's worth doing. Okay. So you have
and that would not be true for C corp, or never be true. But for S corp, I think that's probably, you can feel confident that's what you should expect.
Okay. So what John's saying is A is an original shareholder. Corporation is funded with $10,000 of cash, $10,000 of equity. Okay. And in years 1, 2, 3, it makes, I'm going to say 30,000, 30K a year. No tax distributions, no nothing, just easy, no problem. 1, 2, 3, end. That's going to give me 100 and 100, correct? Then I have 1, 2, 3, basis schedule, 30, 30, 30, 100. We've stayed in sync from an equity perspective inside and out, because our beginning point was exactly, our original point was exactly the same. The same way when we go through the 358 analysis for stock basis, the 358 analysis should equal the equity section of the company. Remember, if we have debt in excess of basis, what's our number, Lane, for
357C.
If we have a 357C problem, what do we anticipate our basis and our stock's going to be?
0.
0. What do we anticipate our basis or our equity section is going to be?
0.
0. So 358 basis and the equity on the balance sheet should be in sync with each other. So in this case, we contributed cash. 358 says cash was contributed, starting old basis cash 10, no gain or loss, no boot, no nothing, ending basis 10, equity 10. So we now have the years of operation where we get $30,000 a year, and we ended at 100 and 100. Well, somebody says, well, that's a nice cash flow. We'll give you $1,000 for your business. Okay? So at 1,000, I have 900 to gain, right? Proceeds, 1,000. Basis, 100. Gain, 900. Equity, 900. So my ending cash is 1,000. My ending equity is 1,000. My K1 comes over here for 900, 1,000. And now we go through the liquidation process. Step 1 is of liquidation process, where do we start, Thomas? Do we start at the corporate level or shareholder level? Corporate, 100% right. Okay? And the corporate level says we got to compare the fair value of the assets being distributed to the basis of the asset being distributed. Nicola, what assets being distributed here?
Well, I'm confused with your math.
Oh, okay. Fire away.
Well, we have 100K and you said they want to buy it for 1,000. How do we get 900?
We transferred our bank account. So they bought everything for $1,000. We say fine. We're transferring our cash to you. Doesn't make any sense, right? In reality, they would have paid us $900 and we would have kept our $100 of cash.
I think he's confused with the K. Like you have 30K, 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 and then it's like 1,000.
Like you took 1,000 minus the
Oh.
100.
Yeah, whatever. Yes, I point for Nicola. That's right. So, and Jameson's starting on equal footing with everybody today, especially since she got screwed out of her card yesterday. Okay, so it's $1 million or whatever the number is. Okay. So, yeah.
How do you find the fair market value?
What?
Do you have
Yeah.
control right before liquidation?
Say that again.
How do you find the fair market value of all assets?
It can be appraisal, or it can be management estimate. But the more you trend towards appraisal, the more defensible it is. Because if I'm sitting on, a share of Berkshire stock and I say it's worth $1, doesn't work. If I'm sitting on a building and I say it's worth $1, but if I go get a building appraisal, solid. If I go get comps as management and say these are the comps on the building, therefore I can infer value, now at least you have a place to fight from. But in this case, it's cash. So I have cash of, how much do I have, Nicola?
What?
$1 million, is that what we said?
That's what you said.
Okay, $1 million, I don't care. Okay, cash is cash. Fair value cash is $1 million, base is $1 million, no gain or loss at the entity level. But now 337 says you have to compare the fair value of the asset received. What's the fair value of the asset received, Nicola?
100
$1 million.
million. That's right.
Right? That's cash coming out of the company. What's my basis? $1 million.
Mm-hmm.
Because every time an S Corp item of income or deduction was generated at the entity level, it made my outside basis rise or fall in equivalent nature. And what John's saying is a rule of thumb is if you have an original shareholder and you have a gain or loss on liquidation, something got off the rails somewhere. That's a stop and say, what just happened? Versus, hey, we have A who bought the shares and bought it for $20K. That now we have a disparity in between the inside outside because he paid more because there was intrinsic value inside the corporation. So now since A is not an original shareholder in the corporation and we liquidate it, I should now have a $10,000 capital loss because that's what I paid in excess of the fair value at the date the transaction occurred. So original shareholder, a good rule of thumb is if I go through 336 and 331, at the end of 331, I should not have a gain or loss on liquidation because every item of income should have affected my basis in the same manner it affected my internal equity of the company. That's a really good rule of thumb. Nicola, who are you going to call on?
We'll go JD.
Let's start tracking yours, JD. Seems like they're picking on you today. What we got for tax deferred?
Do you want me to read it? Or,
Yep.
Sorry. Okay. What are the tax consequences of a tax-deferred corporate liquidation? As stated in the previous page, there's a corporate level rule and a shareholder rule. 337, the corporate level rule, the corporation's distribution of assets is tax deferred and no gain or loss is recognized by the distributing corporation. Do you want me to keep going?
Mm-hmm.
Okay. 332, the shareholder level rule. The shareholder does not recognize gain or loss upon the receipt of corporate assets distributed in exchange for stock. 334, shareholders' basis and assets received. Assets received by the shareholder due to the liquidation of the corp is equal to the liquidating corporation's basis and not the basis of the surrendered shares.
Okay. That is clear as day to me, but how clear is that to anybody else? So 337, there's no gain or loss on the distribution of assets out of the corporation. There's no gain or loss by the shareholder of surrendering their shares. And the hard part, or the harder part to me, is the basis of the assets. Did we talk about disappearing basis yesterday?
Jameson?
Yeah.
We did. Okay, so we have an entity. We have A, who owns X. If X is liquidated, and A is an individual, by the way, if X liquidates, is that taxable or tax deferred, Lucas?
It's taxable.
It's taxable, okay? X has $1 million inside of it. J owns Y. Y has a fair market value of $1 million, basis 0. And J, Y is a C Corp, and J's basis in their stock is, let's make it $1 million. Make it very stark. Since J is a C Corp, if J, or X, since Y is a C Corp, if Y sells its assets, how many levels of tax are going to be inflicted on the $1 million proceeds? Sam?
2.
2. There's going to be a corporate level tax. There's going to be an individual level tax when the dollars come out. There's 2 levels of tax. And if J sells the shares of Y for $1 million, J has no gain or loss. So J is highly incented to want to sell the shares of Y. And X thinks J is an absolute idiot and that the operations inside of Y are worth way more than $1 million. They can do a lot more with those assets. Fine, J's an idiot, so we'll have X transfer its $1 million to J, and J is going to transfer Y stock. And the resting point is you have X owning 100% of Y with A. The basis in the shares are 1 million. The basis of the goodwill or intangible is still 0 because there's no step up that occurs when you buy the stock. So what 337 says is the corporate distribution of assets is tax deferred, no gain or loss is going to be recognized. Lucas, who do you want to call on?
Emma.
Emma, we're going to be liquidating Y because we don't want Y to be part of our corporate structure. And we have 337 that says the distribution of the corporate assets results in no gain or loss. What is the corporate assets that's being distributed if we liquidate Y?
Stop.
Nope. Y is being liquidated. What are the corporate assets owned by Y? And we have this, I got basis in Y stock owned by X of $1 million, basis in goodwill of 0 that's inside of Y. Do you want to phone a friend?
Yeah.
Who?
I'm getting a lot of head shakes.
What's Y's corporate asset? There's no basis, but it has an asset.
Goodwill?
What is it?
Who said it?
You said, okay.
He told us.
I said goodwill.
Okay.
Okay, so if you're lost, let's do it again.
I think it's confusing because it has zero value.
Things going.
Well, it has $1 million of value. We'll make it $10 a basis.
Okay.
Okay.
Thanks. That helps.
Okay, so let's do it again. Because clearly we got off the tracks. So, Y is owned by J. Y has an asset worth $1 million. That asset has goodwill with basis of 10. J has stock in Y, $1 million. X says, I can run that better. I'm willing to buy the stock from J because he doesn't want to sell the assets. I'm willing to forego the step up. So X transfers $1 million to J, and J transfers X or Y stock back to X. The resulting entity structure is A owns 100% of X. X owns 100% of Y. X's basis, because it paid $1 million, is $1 million in Y stock. Since we bought the stock of Y, you don't get a step up of the assets of the corporation you bought. You carry over basis. So the basis in Y's assets of goodwill is still 10. There's no adjustment of basis from J owning it to X owning it. So if we now say the corporation under 337 that's being liquidated transfers its assets, there's no gain or loss. And if we're liquidating Y, who's transferring their assets? Y. And what's the asset that Y has? The goodwill. So it says there's no gain or loss. So the goodwill still has $1 million of value and 10 of basis for whatever. Nicola, you do the math. Okay, but that gain, it still has a fair value of $1 million. Still has a basis of 10. So there's no gain or loss. 337 says there's no gain or loss by Y on the distribution of that goodwill out to X. It's tax deferred. X surrenders its shares back to Y, and what does it receive in return? The goodwill. Is that clear? Because I still see lots of blank stares.
Can you say it one more time?
Y in liquidation transfers its goodwill out to X. X is surrendering their shares in Y in liquidation, because Y is not going to exist when the dust settles.
Yeah.
So it gave up its shares in Y, and it got back its goodwill. Okay? So 332 says that that's tax deferred.
So
X is low.
X is low.
Okay.
So there's no gain or loss at Y when it distributes the goodwill. There's no gain or loss to X when it surrenders Y stock. But at the end, X has the goodwill that previously existed in Y. It's now the owner of that goodwill. What's the basis of the goodwill? 334 says that you're going to reference the distributing corporation's basis. The distributing corporation's basis was 10. So X's basis and the goodwill after liquidation is 10. Where'd my $1 million go? It disappears. You don't get to use, the punchline is you don't get to use the stock basis of the corporation. You have to reference the internal basis of the assets. So, if John Canfey were here, and I'm sure that he found that whole exercise slightly frustrating, is the rule of thumb is, here's two things that you got to take away from this. And you need to know this. So I would, based on everything that just happened, I would dispense with the rules and take away the procedure. The procedure is, if we have a tax-deferred liquidation, two things happen. And what are those two things? Okay? Procedure. 1, both the corp, the liquidating corp, and shareholder don't have a gain or loss. That's point number 1 that you should take away from that. Point number 2 is let's see, what would be the best word? The liquidated assets, help me out, let's come up with the best words. Liquidated assets have carryover basis equal to the liquidated subs basis. I don't know the best way to say this. So when you liquidate, when you have the liquidation, you're going to reference the subs basis. You're going to take the subs basis in the same way under 168 I-7. We picked up all of the depreciation schedule under 168 I-7 and we transferred it over to the corporation. It's just pick it up and drop it. That's the same thing that's happening with Y's assets. You pick up Y's assets from a basis perspective and drop it into X. It's almost a 168 I-7 concept, but it ain't 168 I-7.
Is there any, yesterday we talked about floating basis to try to help with the disappearing basis. Is there anything like that here?
Nope. There's not. Yeah.
So it's a common theme when things are tax deferred that you have to like use the original basis since you don't have to pay the gain or loss.
That is 95% true, Jameson. Okay, because if on a limited basis, if I die, I'm not worth $12 million, nor am I worth $24 million. We can be assured of that. So my assets are going to get a step up in value because it's going to run through my estate, and it's going to go to my children through the estate process. So that would be I guess that in a tax deferred event, but there is a step up without a tax consequence. But as a good rule of thumb, if you hear tax deferred, yeah, it's going to be carryover basis, like-kind exchange, involuntary conversion, tax deferred transactions associated with 351, liquidation under 337, all these things. When you say tax deferred, carryover basis in play. But the problem with that, and why this to me was a kind of a hard concept, was I have two things. I have my basis in X stock, which could be a point of reference to say what's the basis in the assets, and I have Y's basis in the assets that are being transferred up. Which one is it? It's Y's basis wins. So if the basis in the stock of Y was less than the basis of corporate assets, you win. Basis appears. But if the basis of the stock is higher, you have disappearing basis. And that does happen. Okay? And these rules, we're going to use, these rules are in play for S Corp concepts when we talk about something about sub sandwiches. What was that?
Q subs.
Q subs. So when you make a Q sub election, you're going to be operating under these two rules that we just gave you. And the first rule is there's no gain or loss associated with the assets moving from the sub to the parent, but the sub's basis wins and the stock basis loses. That's what these rules tell you. Are we clear now? Because boy, I lost you for a while. It was almost like Dissler yesterday when he said whatever and threw everybody. I did that today. Okay, are we all caught up? Tatum, you don't look very confident. Are you caught up? Do you understand? Okay. Yesterday, we started out with something that looked like that. What was the point of those two circles, Jameson?
C corps have all the rules that S corps do, but S corps have some exceptions.
Okay, so the big circle is rules apply to both S and C corps, right? Is that what you're saying? The small circle is exceptions for S corps. Correct? Okay, so now we're going to talk about exceptions, the exceptions, because the first part, you know, Dissler, do you think we quantified every corporate rule that might be in the universe of what might be applied to both? Over the past day, the answer is no.
Absolutely.
Absolutely not. But we've grabbed a hold of some common ones, and ones that probably affect your daily life versus trying to grab the full population. So today we're going to focus in on, well, what are the exceptions? What do the exceptions mean? How do we quantify the exceptions? How do we interact with the exceptions? And trying to distill it down into the things that are points of reference to help me not screw something up and maybe point something out to a partner or manager that they don't know that makes me feel good about me. Because that's possible. Let's see. What's, Jameson, who you want to call in?
Natalie.
Natalie, what's the one say up here?
Election was made on Form 2553, procedures for late relief. For purposes of this title, the term S corporation means with respect to any taxable year, a small business corporation for which an election under Section 1362A is in effect for such year.
Okay, so the words you really want to, the words you want to highlight in there is the word small business corporation. Because small business corporation has a specific definition, and that specific definition is operating in this exception realm. So the question is, what's a small business corporation? And what does it mean to be? A small business corporation is a category where you have the ability to elect S Corp if you so choose. You can meet the definition of a small business corporation and not elect to be an S corporation, but you can not elect a small business corporation and not meet the definition. You have to meet the definition of what a small business corporation is in order to go in the slot of making an S election. So what this is saying is, if you meet the definition of being a small business corporation, you have the opportunity, if so desired, to become an S corporation. And as everybody knows, which I think everybody knows, Form 2553 is how one makes the S election. And everybody knows, I think, on some level, that if you do a 2553 for an LLC tax as a partnership, you're under 84-111, and you have to run the traps of 351 to get there. So, or the 2553 can be made for an existing corporation as long as it meets the definition of a small business corporation. So, I don't know how hard I'm going to cover the procedures for late relief. I'm going to leave that to Canfy to transfer that knowledge as we go at some point because I hate that stuff. Is that okay, Canfy?
Sure.
I'm going to send them all your way. I'm like, if you screw up late relief, go see Canfy. And actually, Brett Holtzen just did some work on late relief for somebody. I can't remember who that was. So let's talk about that for a second, because I don't even think I cover that. Maybe I do, because we always discover I cover things I don't think I don't. But in order to the 2553 is your election to be an S corp. And in order to be an S corp, you have to meet the definition of a small business corporation, and we're going to cover what that definition is. By what date do you have to file the 2553 in order for the full year to be taxed as an S corporation? Does anybody know? Okay, so let's do it this way. Okay, so we have a full year, 1/1 to 12/31. And I have a demarcation date of 3/15. And really the date is, 75 days after the year end, which happens to be 3/15. If you make the election prior to 3/15, I'm going to call this 2/15. 2/15 is not January 1st, is it? No. But if you make the election in this window from January 1st to 3/15 and you meet the definition of a small business corporation, you are an S corporation for the full year, even though you made it subsequent or after the first day of the year. If you make the election on, or want to make it on 6/15 because your tax provider said, hey, this is a good idea if you make this because you're going to save on self-employment tax, and we're at 6/15, well, you've missed that window. So that first year, since you missed the deadline of 3/15 in order to file that form, technically you can't be an S corp for that year. Now, that's where this point number 2 comes in for late relief. If you get to 6/15 and go, well, I wish I'd made that election, but I didn't. You can late relief is generally pretty forgiving in order to get the S election to be made for that particular year, but you have to have somebody take responsibility for being the idiot that didn't do it. So the letters that we generally write with some level of questionable accuracy is that either the attorney was tasked with filing the 2553 or the accountant was tasked with the 2553. The client, who is oblivious to tax rules, thought either the attorney or the client was filing the 2553. Sorry, please give us late relief. Is that a fair summary?
Yes.
Yes. So from January 1st to 3/15, you get retro back to the beginning of the year. After 3/15, you got a problem. And there is, I'm going to say, relatively generous late relief in order to get it if you want it. Do we use late relief much, John?
I usually don't, because I think you feel real confident you're going to get it, but just anything with the IRS, if you don't you might be 2 or 3 years down the road when they give it to you, and they will have said you filed the wrong returns for a number of years. So, if it's not catastrophic, I'll just tell the client, no, we're just gonna wait till next year and do it right. If it's a problem, then yeah, I think you feel really comfortable you're gonna get the relief, but it might be 2 or 3 years before you get acceptance.
That's actually a reasonable approach. Depending on the client, depending on what's going on, I agree with all that 100%. But the issue that you could confront is, and we'll talk about it, and you might want to put a pin in this, is if you don't do it, you get to 615, and you don't get the election in, year one, you're a C corp. And if you're a C corp in year one, there's rules that we're going to cover.
I'd say more often you're an LLC.
Well, yeah, but I've seen this plenty. But if you're an LLC taxed as a partnership, you can manage that 100 different ways.
Yeah.
You can. If you're an LLC taxed as a partnership, I'm trying to decide whether I want to go down this path or not, but I think I will. Okay, you're a corp. Or versus a partnership. If you're a corp, this timeline is hard. It's hard and fast. There's nothing you can change about that timeline because you have to have that done by 3/15. And if you're a corp and you don't, and you say you take John's advice, well, we don't want to screw with it, you're going to be a C corp for that first year. In exchange for not asking for that late relief, you now have introduced the concept of built-in gains tax, passive income tax, distribution problems by accepting not trying to get late relief in year one. And we're going to cover those things. But John's saying, well, I got to 615, and why do it? Because I'm a partnership. I'm willing to accept the consequence of remaining as a partnership because it's less of a pain in the ass with respect to the IRS. Is that fair?
Yeah, I'd put if I'm a corp, that falls into the bucket to me of this is not a fun thing to not have this right, and I'm gonna go after late relief, I would say.
But, if we get to, but I summarized, I think I captured what you were saying though.
Yes.
Okay. So, if I'm LLC, taxed as a partnership, well, if we file a 2553 on, that's my OCD is going to get the better of me. On 6/30, because it's a mid-year and you got mid-year cutoffs. The act of filing a 2553, we said that there were two things that were occurring yesterday with respect to filing a 2553. Thing one is we were electing to be an S corp. Remember that? What was thing two? You might want to check your notes.
Check the box.
A check the box election is being made with respect to that partnership. And since you have a check the box election that's being made with respect to that partnership, what's the Rev Proc, Emma?
84 and 11.
You are incorporating that partnership as of 6/30. So since it's a brand new corporation or brand new entity with respect to the corporation's eyes or the IRS's eyes, your starting point for making that election is 6/30 because that's the effective date that you're saying you're putting on that entity. Therefore, you have 2.5 months after that check the box in order to get that election put in. And you're doing it by virtue of doing the 2553. So if now, with respect to what John's saying, we have an entity where we get to 6/30 and we're like, well, Dan, we wanted to do it. Well, you can for an LLC because the LLC tax partnership, we're converting to S Corp. Converting to S Corp starts a whole new entity with respect to the IRS with whole new elections, whole new tax counting methods, whole new everything. But then it turns into, do I really want to have the client separate their books and records and have a partnership tax return from 1/1 to 6/30 and a corporate return from 6/7/1 to the year end? Do I really want to bifurcate that process into two returns? And the answer is probably not. You have to have a compelling reason in order to want to do that. So a corporation, to John's point, is you got to make a choice. And if you're willing to take the downside of not going to get late relief, fine, which we've done that. But if it's an LLC tax as a partnership, you got options. Because the check the box allows you to create a whole new entity for accounting purposes, election purposes, and gives you opportunities to do it in the middle of the year if you want. And if you don't want to check the box, start a whole new corporation. Contribute the partnership to a whole new corporation. That's one of those options under 84-111, where 84-111 says you can contribute your partnership to a whole new corporation, and here's how that liquidation works.
Isn't that gonna end up being way more costly though?
What?
To do it that way?
A corp?
Yeah, to like put your interest into a corp to then do the election essentially.
Yes. So, but your point's not lost on me. You just check the box.
So sorry
No,
if you
you're
already
good.
said this. So with the like the late relief, do you have a limit on when you can do that in a year? Or is it, can you really do it anytime between 3/15 and 12?
I think you got 3 years to do it.
Oh,
So like, the punchline is like, you can pretty much, you're gonna be fine, probably.
The one, I have a discomfort once I get out of year one. I mean, I agree with what John's saying, but I've never been able to wrap my head fully around what that really means. And if I can't wrap my head around what that fully means, it causes me a level of discomfort. But John's right. I've seen that rule. To say I fully understand it would be an overstatement. And if I don't fully understand it, that means there's a landmine that may or may not exist. It sure exists in my imagination because I don't understand it. But that doesn't mean it doesn't mean that it means that you probably can. Yeah.
How many times have you got denied?
Never. Yeah.
Is there a way to like uncheck the box if you decide you want to go back to being a partnership? Just like.
Okay. I don't like this rule. This is stupid. Okay. So Kaylee's question is, can you uncheck the box? And we got to do this two ways. And for those that actually want to know something and consult, this is worth knowing. But again, this is a stupid rule. I think this is the way this goes. Not 100% sure, Kaylee, but I think. If you say A and B form X and it's year one, and they say, well, hell, we want to do a 2553, which is a check the box. Inherent in the 2553 is check the box. Well, you get bite number one, or opportunity number one, and bite number two, or opportunity number two, to change your mind within you can just do it. If you make a check the box election with respect to the initial entity in year one, you can change your mind about what that is after you do that. But if you check the box in year three, you only get one opportunity. Otherwise, you have to wait for a period. Well, your next opportunity is 5 years after the election. So for new, You can change your mind. I don't know why that is, that you can change your mind with respect to a new entity. Have no idea why that exists that way. But if it's an existing entity and you do it, well, now you got a period of 5 years that you can't check the box again.
So can you uncheck it after you file it in year one? Like say you file like, we'll just say 315, can you go and uncheck it?
I don't know the answer to that, honestly. I don't know if there's a procedure. I don't, do you know, John? I have no idea.
So when you say bite 1 and bite 2, then what are the,
That means that I didn't want to be an S corp,
yeah,
so I'm still an LLC. Now I'm going to check the box to be taxed as an LLC again.
at bite 2?
That's bite 2.
Okay.
And you have the opportunity to do that.
Because you did your initial check the box. You did your first check the box in the initial year of operation. But if you do it in year 3, well, now you got to wait for a period of 5 years in order to have the opportunity to go back into the check the box regime and change your status. Yep, and I don't understand why that rule is what it is. I just think I know that's what the rule is. I'm pretty sure that that's right. Okay, so let's talk about small business corporation. Because at the end of the day, we said that you have to meet the definition of a small business corporation in order to have the opportunity to be able to elect into the S status regime. So in order to be able to elect in the S status regime, we have to be able to define what a small business corporation is. So it's under B, which when I was your age and going through this, I didn't particularly like this. I'm not sure I particularly like it now. But they do everything in the negative when they're defining what a small business corporation can be. So for purposes of this subchapter, a small business corporation means domestic corporation, which is not an ineligible corporation. And I'm like, what the hell does that mean? And which does not, an eligible corporation is a bank. A bank can't be an S corp. No, an insurance company. It used to be a bank, that changed. And which does not have more than 100 shareholders. So if we come back over here and we have 2 corporations, and you have X and you have Y, and this has 101 shareholders, and this has 20, well, X is eligible to be a small business corporation because it does not have 100 shareholders. Y cannot be an S corp because it does have 100 shareholders. Yeah.
Is it just at the time of election? Can you have like 200 and then?
Nope. If you bust, the minute, that's a great question. The minute you stop meeting the definition of a small business corporation, you no longer are an S corporation. You've given up, you've busted or lost your right to be an S corporation because you no longer meet the definition. So going back to it, Jameson, the only way you're going to be able to be an S corporation is to meet the definition of a small business corporation.
Like the whole life
Yep.
of your firm. Okay.
The minute you don't meet the small business corporation definition, you can't be an S corp, which means you bust your S selection, which means now you're a C corporation.
What if,
What if?
like, for 2 days, you have 101 partners that year, and then you realize, oh shit, I'm over the threshold, and you take out 2?
You're screwed.
Really?
Mm-hmm. The minute you cease to meet the definition is the minute you cease being an S corporation.
Even if you.
TK, are we here to be experts or are we here to know something?
No, learn.
We're here to learn. Okay, so your question is a good question. So I put up a slide pretty early on. A good practitioner knows the rule. A better practitioner knows the exception to the rule. And a really good one knows the exception to the exception. And this falls into the exception, right? This is, I'm going to say, a middle of the road practitioner should possibly know this. There are rules, and I don't know if your particular fact pattern, it probably does actually, would fall under this regime. But if you inadvertently do something stupid and you cease to meet the definition, you can go ask the IRS for relief. But you have to ask. So whoopsie. I have 102 shareholders. We got rid of them. We took corrective action. Can I keep my S Corp status? And you have to go get a ruling. And does anybody know how much your ruling costs? Take a guess.
$100,000. That's for our fee.
10,000.
100 grand.
Oh my goodness.
That's
not
not for our fee. It's not cheap.
What?
It's not cheap. So means that we have to have 100 or less shareholders in order to meet the definition. Let's see. A shareholder has have a shareholder as a person. So let's talk about a person. I can't remember how this works.
Isn't there like a rule with like related parties that are to be one person?
For the 100?
Yeah.
There is rules about that. Okay? And what Lane just asked was, in measuring the 100, is there related party rules that assist in measuring the 100? And the answer to that is yes. Because if there are 100 shareholders and shareholder number 101 decides that they're going to create a legacy trust, or they're going to transfer shares to their children, or they're going to transfer shares to their wife, there's a whole category that I don't know off the top of my head that those related parties get counted as one shareholder for purposes of counting the 100 versus being 10 shareholders because that's who owns it. There are related party rules. I can't articulate them off the top of my head because, quite frankly, I can't tell you that I've ever seen 100-person or even approaching 100-person shareholder group for an S Corp. I haven't. So there are related party rules that you get to count as one because I've never had to confront that. I know it exists and I can't articulate what that is. I wish I could remember. Have as a shareholder a person other than a state trust described in C2, an organization in C6, who is not an individual. A person who's not, okay, yeah, that's right. And this is worth knowing for if you actually have to read something in the code and digest it and try to figure out what your bearings are. So if you highlight the word person in this code section, person in this section means a corporation, means a trust, means an individual, means a partnership, means when you see person in the word in the code, that word person is quantifying the universe of possible taxpayers. When you see the words, I think, natural person in the code, that means an individual. So that's worth knowing, because if you read person, you automatically think we're talking about a human. That's not what this is saying. So a shareholder, have as a shareholder other than the state. Let's click this link and see where it takes us. Why wouldn't we? Okay. Okay. Certain trusts permitted as shareholders. And we're going to hammer on this a little bit. Okay, so why don't we stick with the rule of thumb first with respect to what this provision is telling you. The rule of thumb is if you don't have a U.S. individual as a shareholder, you better ask a question. That's your rule. TK, are we here to be experts?
No.
We're here to learn. What rule did we just learn, TK? If it's not a U.S. individual, ask the question. And not rarely, you're going to see trust in estates in this, but a resident, a foreign person can't be a shareholder. A naturalized U.S. citizen is the only person in your world that's acceptable until somebody tells you somebody else is okay. That's your rule of thumb. So talking about trusts in estates, and we're going to get into this, but we should touch on it a little bit. A trust is not a U.S. individual, is it? It's not. It's its own tax-paying being. So there's these separate categories of trusts that say, well, even though you're not a natural U.S. citizen, you're okay. You're still going to meet the definition of a U.S. shareholder or an appropriate shareholder. One is a grantor trust, and we're going to talk about a grantor trust. And grantor trusts, and I'll give a little preview because another iteration when we finally get there is okay. So a grantor trust comes in two categories. First category is irrevocable. Second category is revocable. And what is grantor trust? I mean, when I say grantor trust, what definition should you take away from what that means? A grantor trust, for your purposes, a grantor trust equals a disregarded entity. That is probably the best way I can frame it for you from a 50,000-foot view of what you're dealing with. A grantor trust is a disregarded entity. Now, Sam, do you really think that's true? No, it's not true. But for purposes of what you need to be able to define this as and be able to interact with it, does everybody in the room understand a disregarded entity? Yes, they do. And everybody in this room understands that a disregarded entity says that whatever income tax consequence occurs with whatever is owned by that trust is transferred or reported by the person who, see, this is where it's not true. It's transferred to the donor, okay? Because the DRE, this is what's different, and I wanted to try to avoid this, but I don't think I can. Land. Okay? That's the DRE. Single member LLC, A transferred the property to the land, or transferred the land to the LLC, and A is treated as owning that land. So if the LLC sells the ground, the gain is going to be inflicted on A, the person that transferred it. In this context, you have A, who transfers land, and you transfer the land for the benefit of son or daughter. The son or daughter has full rights to that ground at this point, based on whatever the trust document is. A has full rights to the ground here. This is the difference. But if the land is sold by the LLC, the DRE, the gain is reported back to A. If the trust sells the land, even though A can't have it anymore, the gain goes back to A. So in the manner that the income tax consequence of the LLC and the income tax consequence of the trust are inflicted back on the person that transferred the property into that vehicle, it's a DRE. The income tax consequences of that particular vehicle are going to be reported by the person that transferred it. That's what grantor means. And that's why I tried to put it in the context of a disregarded entity.
Aren't these the ones where like page 1 of the trust says like no reportable income, and then the grantor letter has all the details of the return?
Yes.
Okay.
Yes, that's exactly right. Okay, so now we're going to say grantor trust is DRE. And we have grantor trust up here. And we know that a grantor trust comes in 2 different subcategories: irrevocable and revocable. Okay, in revocable category, you're going to see this if you have somebody that says, I'm worth $10 million. And I can assure you I'm not. And they say, let's do it this way. If I die and I have $10 million, and I have a brokerage account, and I have land, and I have a car, and I have a house, and I have a balance sheet of all these various items, and I die. Well, if I don't have this revocable trust, all my assets have to go through a court proceeding called probate. And if they go through the court proceeding called probate, the people that I love are going to have to endure going through probate, and they have to prove that I actually have that brokerage account, I actually have that land, I actually have these items. Because I could leave my children the Brooklyn Bridge, but I don't have title to it. So probate says, well, that's great that you left the Brooklyn Bridge to your kids, but you don't have title. Probate is a process of proving title and the decedent's ability to transfer that asset to the next generation. That's what that's about. So if you say, I don't want to inflict that process on my family, I'm going to transfer my car, my land, my house, my brokerage account, and all these assets into something called a revocable trust. And I'm alive. I actually have to go through the process of retitling these assets into the revocable trust. The act of me retitling these assets back into the revocable trust tells probate everything's good, it's got good title. And now those assets can avoid that probate and go to my heirs, and they don't have to deal with that. That's why a revocable trust exists. Oh, I think we'll take a break and we'll talk about irrevocable when you come back.